Oh boy, welcome back to another CPI day and happy birthday to Lauren. We are about 60 seconds away from the CPI release. Quick heads up and congratulations to the team. We have not only gotten our house hack vests, which were custom made, which is super cool. One of our team members, aunts, made them, but get this. We have officially launched actual financial advice. Check out the link down below to learn more about that. It's stackhack.com. Actual financial advice, which is super cool. Fundamental analysis and actual financial advice, licensed financial advice. Super cool. Anyway, CPI numbers. We are expecting 0.2 month over month, 0.2 core. We really want to see at expectations or low. And then we're going to go into the details. Year over year, we're expecting 3.3. We think next month could be a little hotter thanks to oil prices. Here we go, and it comes in at 0.2, 3.2 year over year, better than expected, and a 4.7 for core year over year. So we get a match on core year over year, match on the month over month numbers, and slightly soft over that year over year. Now the most important thing is going to be going through the actual numbers and seeing, oh snap, what are some of the details of what we're facing? So let's go ahead and pull up that CPI BLS report, get into the details. We were expecting used cars and new autos to come in a little soft. CPI for BLS, we're going to get that report and we're looking here, but this is pretty much right on target. So this is along expectations. This is good. We really didn't want to get anything hot here because it would have really shaken the disinflation narrative, and we're not in like the super happiest time right now in the stock market. Although futures are climbing at the moment, which is good. Let's see. I know there are a lot of people, though, who are looking for another opportunity to buy. We've had like 3 weeks here almost of an opportunity to buy. And let's see what we get in terms of some of the numbers here. CPI a little weaker than expected on that year over year is great. Let's get into the actual report. Here it is popping up right now. All right, let's get that screen to show. Come on. Sorry, 1 second there. CPI, there we go. Okay, perfect. The index for shelter was by far the largest contributor to the monthly increase for all items, accounting for 90% of the increase. Holy crap. This is the first time we've seen 90% of the inflation in the BLS report come solely from shelter. That's insane. That means as soon as that shelter move is gone, there's nothing left. We're probably at deflation. The Financial Times actually made a whole counter argument, though, to China exporting deflation, which was an argument Cathie Wood made just the other day. And Financial Times doesn't seem to agree that China is going to be exporting deflation. But boy, that is not a lot of leftover inflation, at least based on the way the government tracks it here. I know a lot of folks have been pretty frustrated, especially by food prices. Here are actually food prices, seasonally adjusted from the month before. Look at this, 0.2 here for food, 0.3 for food at home, 0.2 for food away from home. We're going to get into some more of these details here. Food accounted for 0.2. Food, okay, we just read through that. Let's see here. We have an energy index rose 0.1% in July after increasing 0.6 in June. Gas 0.2% in July. We think this will actually be higher for the August CPI report, so buckle up. We are, let's see, energy index fell 12.5% over the last 12 months. That's fine. There's going to be a big question because if we end up getting a big energy boost next month, there's a question of, okay, is the Fed going to be willing to look past an increase in headline because of inflation rising in energy? Are they going to look past headline and only focus on that sort of sticky core section? The index for all items less food and energy rose at 0.2% in July, as it did in June. Shelter increased to 0.4%, the same increase as in June. Index for rent rose 0.4%. Owner's equivalent rent, 0.5%. Index for lodging. This was surprising to me. It really seemed like you got that international travel boom. And outside of the U.S., like U.S. travelers went to Europe and other places. And what did that actually lead to? It led to a decrease in lodging prices in America. I mean, this is quite frankly the opposite of what I was expecting to some degree. The shelter index was the largest Factor in the monthly increase in the index for all items less food and energy. Among other indices that rose in July was the index for motor vehicle insurance, which increased 2% after rising 1.7% in the preceding month. It's still pretty aggressive here on insurance prices, catching up. A lot of catch up here. Those are part of the stickier services sector, so not so great. Education, recreation also up there. Keep in mind that these insurance premiums have been skyrocketing for real estate sectors as well, especially in places like Florida. I mean, look at what's going on now in Hawaii. It's absolutely devastating what's going on in Maui. You've had over 30, I believe 6 people die now in Maui as a hurricane pushed fires to a historic older town. It's very sad. Several indices declined. Listen to this, led by airfares. What? Which fell 8.1% over the month, its 4th consecutive monthly decline. The index for used cars and trucks fell 1.3% in July after decreasing 0.5% in June. I'm going to take a quick look and see what the suits are saying here. The suits are reacting to this as well. Also, quick reminder, first link down below, we're now doing actual financial advice. We've got a team of financial advisors now, which is super cool. So whole portfolio reviews, fundamental analysis, really neat. So check out that first link down below or email us at Kevin@StackHack, like get stacked with StackHack.com. Okay, so market, let's see, CPI food prices were up. 4 out of 6 major grocery food indices increased on the month. That's quite a bit, 4 out of 6. Got, let's see here, the shelter cost increase. This is what I wonder, like everybody keeps saying it's going to roll over. When, please? When? Shelter cost index is expected to wane in time, incorporating the slowdown in rents that happened a year ago. But housing costs further out are more of a question mark. Okay, we also got job numbers just now, by the way. Weekly jobless claims coming in at 248,000 versus 230,000 expected. So a little warmer than expected, although continuing claims falling, implying people are able to get jobs. Kind of weird. Fed swaps are now pricing in a lower chance of another rate increase. My expectation, by the way, with no rounding, was that inflation would rise 0.15%. It actually rose 0.16%. If you want to do the actual math on that core CPI figure, we're looking at 308.8 versus the consensus of 308.941. And the prior read on that actual number for core was 308.309. So you can divide those and get 0.16 was the actual month over month core. Again, I was looking for 0.15, but of course that gets rounded as we look at the first digit there after the decimal. Communication declined 0.1%. Index for used cars and trucks fell 1.3%. We have waiting for Supercore. Supercore takes a hot minute to get calculated, so that'll come in here shortly. Dollars weaker after the report. Prices that held inflation down: airfares, used cars, trucks, medical care, communication. Let's see here. Okay, let's keep going here. Okay, so not seasonally adjusted. Let's see here. The consumer price index. Okay, we saw this. This is some of the numbers here. These are some of the numbers that are going to help us calculate Supercore, which we'll do in a moment. Trying to get some more of the deeper data here. Let's see. Prices for various items, fine. Same thing. Okay, let me get to the chart now of all of the items. But so far, this is pretty good. We want to see economists start getting more accurate with their estimates here, because it's usually in like recessionary times that the accuracy of these reports goes to crap. I mean, remember when inflation was starting to hit, nobody was getting it right. We were off by orders of magnitude, it felt like. Okay, let's look at these actual categories. So what do we have here? Now, food did rise 0.2%, but we're okay with 0.2%. The problem is, you got bread rising like crazy here, 0.9%, not great. Meats rising 0.5%, also not great. You got dairy products up 0.5%, also not great. Fruits and vegetables up 0.4%, not great. Non-alcoholic beverages, 0. Coffee, 1% in a month. Let's make sure of that really quick. Yep, there's our June 2023 to July figure, so our far right column. All right, let's get to some of these other goods sectors. So now we're in goods. Goods right here. We want to see disinflation, maybe even deflation. Look at that. Window and floor coverings, minus 1.3%. That's going to be great for house hack. We're going to be raising money for non-accredited investors very soon, which will be very exciting, probably the next 2 to 3 weeks here. We're very close now that we have sort of a thumbs up-ish from the SEC. Well, I don't know if that's the right wording for it, so ignore that. But you could go to the SEC filings page to learn more about it. Furniture and bedding, minus 0.4. Window coverings, 1.1 to the downside. Furniture, 1.2 to the downside. Although I believe, was it Lazy Boy or Lovesac? One of those has started doing pretty well. Appliances up 0.5%. Starting to see home builders increased demand here for, it looks like at least some appliances, but we have other appliances. I'm not sure exactly which category is giving us that, given that the subcategories here are negative, but okay. What else do we have? Other household equipment furnishings up 0.5%. Clocks, lamps, decor, fine. Tools and hardware, outdoor equipment, 0.7 to the downside. Household supplies, flat. Apparel, flat. That's the apparel broadly. Transportation commodities, less motor fuel, negative 0.5. That's going to be for your tires. Used cars, trucks, negative 1.3. New cars down 0.1%. This is what we were expecting based on the auctions data anyway. So this is great. Dollar's weaker after the report. Another sign the market is dovish here on this, which is great. Remember, Bill Ackman shorted treasuries when the 10-year was sitting at about 1.2. The more yields fall, the more that short's actually going in the opposite direction. And it looks like we're at a flat 4% right now, with NASDAQ almost up 1% here. So we'll keep an eye on that as we get a little bit more data. It's actually closer to 0.75%. Continuing on, medical care commodities up 0.5%. These are all our goods section still, right? A lot of disinflation in these goods. Pet products, negative. Sporting goods up 0.1%. That's fine. Photography equipment, 3.3. Rec goods, 2.4 to the downside. This is almost all of this is negative in terms of goods. Alcohol, 0.1%. Alcohol away from home, 0.2%. Personal care products, 0.5%. There's shelter. Look at that. 90% of the increase, folks. Shelter, shelter, shelter. And it's not even lodging away from home. Wow. Other lodging away from home, including hotels and motels, negative 0.5%. It's only rent that kept us going here. That's remarkable, especially since leading indicators are we should be flattening out on that. Medical care services, negative 0.4%. Good, 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 good. Transportation services, 0.3%. Also good. Motor vehicle insurance, that's painful. 2% right here, not great. Motor vehicle repair, not great. Those together sitting at about 3% of CPI. Public transportation down. Recreation services, 0.8. Not great. Pet services, including vet services, 0.7. Not so great, but only about 0.5% of a weight on CPI. Okay, education services, 0.3%, which have a 4.7% weight. Postage and delivery, down 1%. Telephone services, 0.1. Haircuts, 0.6. Miscellaneous personal services, negative 0.5. And then look at that here. Financial services, negative 3.1%. Yeah, that's probably because for a limited time, we're now offering licensed financial advice for what we think is a really, really great price. Link down below. And it's not commission-based either. It's a really good consult. Okay, let's get a little bit more look at what we have here. Zooming in on rents, the biggest and most important component of core inflation. Owner's equivalent rent rose 0.49% in July, marking actually a slight acceleration over June's 0.45% increase. So this is the part that needs to roll over. So when is it going to roll over if it's actually trending up rather than down? A little weird. Today's data shows disinflation may prove choppy from month to month. Well, yeah, no kidding. Costs for nursing homes surged by 2.4% month over month. Not great. Housing at school went up by 0.9%, and that's as college is about to begin. So not that great here. Looking for a little bit more data on where our super core figures are. Expecting to get those here. We can do some math on these in just a moment, but we're going to get charts in just a moment here. Let's see here. Okay, what do we have here? Okie dokie. Energy prices fell in July, a reading from the prior year, and decelerated. Yeah, we know that. Okay, what do we have? Getting a little more data here. Headline point 2. We know it's only 0.16. That's fine. Goods and services. Let's see here. Year over year services at 6.1% to the upside. Oh, somebody give me Supercore already. Okay, here we go. Supercore chart. This is coming in at. Okay. 0.019 on Supercore. Supercore month over month, 0.019. Annualized, that comes out 0.019 times 12. Annualized, that just means that's essentially flat, 0.019. Could that be right? Hold on a sec. No, that can't be right. Well, let me see here. We have, doing the calc, let me do it myself. Negative. Let me send over, I'm going to send over this screenshot. Give me a moment here. Let's do this together. Okay, because we got a negative component in here as well. I have a chart breaking it down now, and we'll go ahead and go through it together. Ooh, kidoki. So we'll get Supercore in a moment. Wall Street information's actually coming through a little slow and boring right now. Okay, pretty quiet otherwise. Let's get this here. All right. Give me 1 second here. 0.63 on the NASDAQ. Okay, there we go. So this is what we've got in terms of, come on, iPad. There we go. Okay, here you go. So this is what CPI month over month looks like. This is a lot easier to visualize. So CPI month over month looks like this. Remember, it comes in at 0.167 to be exact. My estimate was 0.15. This is the month over month figure. Core number comes in at exactly 0.16. And then here's our super core, which there it is, 0.19. 0.19. That's more more correct. 0.193. We multiply 193 times 12 to annualize. You're sitting at about 2.3% annualized super core inflation. And you can see some volatility in this, with transportation services adding a little bit more than they did in the last month, but not as much in the month prior to that. That's your blue chart, bar chart on the right. You've got medical care services actually adding to a weight to the downside with 0.1% to the downside. You've got, let's see what else we have here. Rec services contributed a little bit more, almost at that 0.1% now. Education services popped a tiny little bit as well, 0.05. So there's our super core, 0.19. It's good to see it under 0.2. It still annualizes over 2%, but 2.3% on an annualized basis. You look at that, that's good enough for you to say, hey, flexible average inflation targeting, and it's gone. Oh, you can't even see that. Sorry, my bad. There you go. There you go. So this gives you that super core chart without me sitting in front of it. Again, 0.193. So NASDAQ now rising, sitting at about 0.85%, looking at SPY as well. And we'll get some other data here. SPY sitting at 0.54%, waiting for treasuries and break evens to move as well. Inflation largely in line. Claims jumped a little bit. That might be a story for today, is claims rising a little bit. But then again, continuing claims are coming down. And I think that's important to mention as well, is, you know, if people lose their jobs, that's one thing. But as long as you can get another job, you can keep spending. Inflation break evens just fell. We're looking at 2.24% on the 5-year break even right now. If we go to the 5-year forward, this is a new one that all of a sudden people are really focused on, is instead of what is inflation expected to average over the next 5 years, which the 5-year break even tells us at 2.24, people are looking at the forward 5-year break even. Forward 5-year break even says, okay, going out 5 years, how much do we think inflation is going to be in 5 years? So in other words, in 5 years, looking forward 5 years. Kind of complicated, eh? But anyway, when we look at that one, you can see a little bit of a volatile chart. I'll pull that one up, make sure I'm not in the way for this one. Okay, here we go. Yeah, not in the way for that one. So that explosion on the right side in that forward 5 year was creating a little bit of nervousness for markets. So this explosion is something I think you're going to see a little bit more of. Although now with this inflation data, I think you're seeing some softening here. Again, dropping to about 2.39 off of that 2.55 figure. So good fall over here. This will be, I think, overall good news for the whole disinflation narrative on all sides, since the Fed is going to be watching the break evens as well. So looking at other commentary here, core services excluding housing, medical care services, which have been affected in recent months by health insurer profits, actually re-accelerated, rising to 0.4%. Calculation is more consistent with the inflation gauge the official Fed targets. That's going to be your PCE figure. So a little bit of a bump here on your medical care. Similar. This is core services excluding housing, but also excluding medical care services, up 0.4%. This is another way of slicing super core in fancy different ways. The reason people look at all these different cores, super core, removing housing, for example, is so that way they can look at what's the sticky component. How sticky is inflation in the services sector, really? So far, it's suggesting not really. The disinflation trend rather gaining momentum. Core CPI here growing at just 3.1% annualized over the last 3 months. That's the slowest pace since September of 2021, and down from 5% and then 4.1% in the last 2 months. This is actually a really good trend. This is your 3-month annualized. I'll go ahead and show it to you on screen here. Take a look at this. On screen, you're seeing the 3-month core annualized change. So you take the last 3 months, add them together, multiply them by 4. That's going to give you the annualized core change based on a 3-month average. And what do you have over here? Massive decline. This is fantastic. We really want to get to where the Fed can actually start claiming victory on inflation, to the point where the Fed can relax on not only interest rate hikes, but start lowering interest rates. And that way we can ensure the economy doesn't fall into recession. Okay, let's see. S&P 500 is still up 59 basis points. Tesla's up 125. NASDAQ almost at highs of the pre-market here, up 0.91. We'll be paying attention to some of those momentum movers as well. I know a lot of folks looking at WeWork to potentially pull off Yell. Keep in mind, what a lot of people do is they'll they'll buy really short dated YOLO calls on some of these companies trending towards bankruptcy, hoping for a 10x on something like what happened with Yell. Just be careful though. I mean, you look at Yell, there's so little trading and you could see a negative 44% in a day. So keep in mind that could crush some of your numbers pretty quickly. And watch that implied volatility on some of these as well. Implied volatility on these companies trending towards bankruptcy can explode. Okay, looking a little bit here, a little bit more into what Wall Street's saying. We're looking at 2 good inflation reading. Oh, of course. I love lines like this. Here's a quote from CIBC Capital. 2 good inflation reports are not a trend, but are very welcomed. It's like 1 report's not a trend. 2 reports are not a trend. My gosh, it's always everything's not a trend. Meanwhile, we trend down. Okay, so overall, I have to say, this looks like a pretty dang good inflation report. The worst news this morning is that we are higher than all 42 forecasts in the Jobless Claims Survey, coming in with 248,000 weekly filings. Expectation was that we were going to be sitting somewhere at 230,000. So we're coming in a little bit more aggressive here on those weekly claims. But the continuing claims coming in soft is a good thing. And these estimates are always subject to weekly distortions. So probably not something we want to read too far into. Instead, CPI coming in at expectations, if anything, slightly to the lower side, with Supercore coming in at just 1.9 or 0.19 rather. and a 2.3 annualized is great. Fantastic news. Check out that first link in the description down below. We now have actual licensed financial advice, which is super cool. You send us your bank statements, credit report if you got one, or just pull a recent free one from annual credit report. We go through all of your financials and come up with a plan for you. I make a video for you on your plan for a path to wealth for you, which is great because we all know the principles of building wealth are pretty pretty strongly outlined, whether that's in the courses on building your wealth or otherwise. But then the question is, how does everybody apply that individually? And so we're excited we could finally bring a product like that to market. I think it could be the first time we're seeing actual financial advice on YouTube. Usually everybody says, no, those are not financial advice. But now we could actually look at your personal financial situation. So that's exciting, as well as if you have fundamental analysis you want on a particular stock, we can get the entire team working on an analysis for a stock that you'd like, which is pretty cool. So check that out, link down below. Looking a little bit more here, Bloomberg economists, and now we're playing subdued core CPI readings for July is the second straight month where inflation annualizes to the Fed's 2% target. That's going to be core, not just super core, right? We think disinflation has legs, primarily reflecting the lagged impact of the past Fed rate hikes and the downshift in economic activity, with credit conditions to tighten further. Yeah, I do somewhat argue that at some point we're actually going to see more credit loosening as the Fed's disinflation narrative takes over. You're actually going to trend towards credit loosening rather than credit tightening. And I think that's something that's pretty wild that a lot of folks aren't paying attention to right now. And I think that will be a tailwind to your financial related stocks. Think sort of your PayPal. Boy, do some fundamental analysis on PayPal. You might hate the company's guts, but you look at some of the numbers, it's starting to look a lot like Facebook did back at the end of last year. Meta stock was pretty depressed there for a while. Wrinkle is rising oil prices for the next coming months, making potentially August headline CPI quite ugly. Still, with inflation expectations down significantly, Fed officials would likely look through the oil price increase. And while policymakers won't declare victory yet, Fed speak at the July CPI print may hint more clearly that the FOMC won't raise rates at the September meeting. Sort of a summary here, looking at WTI futures right now sitting at 0.62, Brent sitting at 0.41, both to the downside for oil, though Brent's still almost at $90 a barrel. So we've definitely had quite a little bit of push here on oil, despite the Chinese economic woes. So, if China were booming on all cylinders, maybe we'd actually be getting that $110 per barrel oil, but not there right now. Really back to where we were for U.S. stock futures, 10-year treasury yields, relatively stable here. We'll see how the day evolves. Annual super core figure, it was transportation services and other that really pushed that higher. We looked at that in the super core as well, so we saw that. So nothing super newsy here. Yeah, we'll do separate kind of topics here on AMC and some of the other things going on. But hey, as far as CPI, this I think is great news. Thank you so very much for watching. Really appreciate it. It's fantastic. And yes, Max still planning on doing biz visits as well for actual financial advice, which will be really cool as well. So stay tuned for that. Thank you all for being here. We'll see you in the next one. Have a great trading day. If you're trading or if you're looking for a buy and hold, good luck. And we'll see you soon. Thanks.